And for his insight on the markets, we're now joined by Jared Levy, managing partner at the Chapwood Fund. Jared, thanks for joining us. So, U.S. markets recovered a little today. Is that because investors saw that decline as a buying opportunity?
You know, it's funny, we find ourselves in these psychological conundrums, right? These times where we dip and you're questioning yourself, is this the buy time or is this the sell time? And the question that a lot of investors are asking themselves now is, what is my time horizon? If your time horizon is 2, 3, 4 years out from now, then yes, you're buying these dips. If your time horizon is a month out from now, then you're probably going to be a little bit more cautious. And I do believe that the markets still do have some more downside to fill here in the next weeks, especially if, like you said, the BLS report is bad.
Okay, so then you're not saying now is a good time. You're still seeing a little bit of a correction to continue. Now, year to date, the S&P's down 5%, the Dow down 6.8%, the NASDAQ lost 3.4%. Now, technically, for a correction, we need a 10% pullback. So is this the start of the correction that many have been anticipating? Do you think we're going to get to that 10% withdrawal?
I hate to assign such hard numbers to a sell-off, but I do, Michelle. I think the market does need to correct 10%. And the reason is simply the fact that the earnings trajectory has not kept up with the rally we saw in stocks. You said it last year. We saw almost 30% increase in the S&P. Earnings only increased about 12% last year. In fact, we're just seeing that right now. And on top of it, 2014 estimates are only looking now for about 8.9% earnings growth. So given that statistic, given the fact that the Fed is withdrawing its stimulus, in my opinion, I think it's more healthy that we do continue to move down. And I do think we'll hit that 10% down mark.
But, you know, Jared, the more concerning trend in the earnings reports has not so much beating on the bottom line, but the fact that revenue hasn't really increased. It's that the top number hasn't accelerated. Is that being factored sufficiently?
I don't believe it is. And this is an interesting statistic you brought up. 1.8% is the amount of year-over-year revenue growth that we've seen in the S&P 500 thus far this earnings season. And when you look at that and you look at the 12% growth we saw in earnings, there's something that's happening, and that something is cost reductions. Cost reductions generally come in the way of jobs. And as we know, a lot of the jobs that have been replaced here in the United States specifically have been lower paying jobs. So again, the question now becomes, does the middle class have the resistance to keep spending? Is that lack of revenue growth really going to translate to continued earnings? And the way my models are shaking out, I don't see it, and that's why, for me, I'm a little bit more cautious going in here. The Chapwood Fund is not correlated with the S&P, so we tend to be a little bit more on the bearish side. But believe it or not, I am an optimist long term. I just see that correction moving a little deeper.
So, Jared, how bearish is bearish? Where do you see us by June?
June, I think that the S&P moves below its 200-day moving average. I think we'll flirt around that area, and that's right around the 1700 mark. Really, it's predicated upon, economic growth. If we continue on this slowing down that we're seeing in manufacturing, saw it yesterday, if that continues, then we could go even deeper. For now, I'm looking for another 5 to 6% down in the S&P before we resume our way up. So yes, I'm looking for a deeper cut by June.
Well, this recent sell-off has been fueled by, as you mentioned, poor earnings. That manufacturing report out of China a few weeks ago caused a lot of concern. Emerging market countries, including Turkey and Argentina, they've been very unstable. And then, of course, the Fed tapering. Overall, though, what do you think is the #1 concern for the markets?
I spent a lot of time trying to understand the psychological makeup or the general consensus of the crowd. And I think as a trader or investor, you need to not only look at the numbers, but look at how the numbers are being interpreted. I think that we've been extremely tolerant of lackluster numbers. And in fact, last year, if you look at just general economic growth, it wasn't that great, but the markets were okay with that. And I guess, Michelle, right now, what I'm trying to figure out is, how are the markets feeling about this? I look at things like Twitter, I look at the news headlines, and yeah, they're still resilient. You heard the interviews with the traders earlier. They're still resilient. They're still buying these dips. But for how long does that last? And at what point does the news really become a problem? And for now, I don't see a big catastrophe globally forming in 2014. But I do think you got to keep your eyes out.
Well, Jared, one of the big reasons behind that massive rally we saw last year was, of course, the Fed's massive stimulus program. The tapering has been taking a toll on U.S. markets, definitely on emerging markets. Do you think that that may influence future Fed tapering? Some are saying that if the jobs number on Friday is not so good, combined with that weak jobs report we saw in December, that the Fed may reconsider stopping the tapering program. What do you think?
I think that is a possibility. And remember, Janet Yellen takes the helm now, and we've got a new Fed chief, and she does have her own maybe slightly different agenda than Mr. Bernanke, although they do tend to follow pretty much the same school of thought as we've sort of found out and heard from her. I think you hit it on the head. If we do see deterioration, specifically in the jobs numbers, and again, last month was very bad, I think tapering would slow down. The other thing we're keeping our eye on is interest rates, real interest rates. And as you've seen in the bond market, we actually haven't seen the big sort of flight. I mean, bond purchases are decreasing, but there hasn't been this big sort of flight away from bonds. People are still sort of supporting that market. So really look at the rate. The rate is going to sort of dictate what happens here. And obviously look at that BLS report. And yes, if the numbers don't add up, then we could see a further taper or slowing of the taper.
Okay, so Jared, where are you putting your money? Which sectors are the most resilient right now and most likely to gain?
Unlike a lot of my colleagues, I'd be really careful with certain financials here, especially those with exposure to mortgages. I'm gravitating towards some of the boring stocks, the utility stocks of the world. I still like Google, and I still like Apple slightly here with the pullback if you're looking for a little bit more risk. But again, I think the dividend payers and the utility companies and the MLPs still here are stocks you want to look at for 2014, at least the first half.
All right, great stuff. Thanks so much, Jared Levy, Managing Partner at the Chapwood Fund. Thanks for joining us.